Real inflation seems to be coming in a little bit better than markets expected. That's certainly starting to revive a little bit of hope for Fed action. See how the markets managed with that information today. It was a bit of an adjustment. And what comes next as we ask consumers whether this is actually encouraging for them? What that means for the economy and, of course, for markets to follow. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And the first thing that we are going to do here is take a look at the data as it presented itself today, and then consider how it impacted markets, what they now think, and what this means going forward. So let's first take a glance at the performance dynamics here, because it is important to break down what markets actually did. And we can see here a little bit of an improvement, not exactly anything to write home about, but a slight uptick in equities land after a little bit of a downdraft yesterday. But the reaction really elsewhere. We can basically check crude oil off the list. It's attempting to digest. There's a fractional gain here, but that's after all kinds of gapping. And on net, actually, crude oil prices are a little bit lower intraday compared with where they opened, and all of this is after a jump of in excess of 5% yesterday around the pullback of non-essential personnel from U.S. embassies in the Middle East, notably in Iraq, and that seemingly suggested that maybe there's some sort of a geopolitical clash that's coming. We didn't see that move extend today, but because there was an upside gap at the futures open overnight, we do have this modest gain. Bitcoin off on its own today, not really falling in with macro narratives, and seeing its losses late in the day, close to 5 hours after all the data came out. So seemingly doing its own thing. The biggest sort of macro narrative that captures markets today is most readily on display in yields, in bonds, in gold, and in the dollar. We see yields here take a significant leg lower, bonds meaningfully higher across the curve, and the deeper you get out into duration, the higher they go. The 10-year rate down 1.2%, the 2-year down almost a full percentage point. Taking a look at where we are on the 30-year gets you even more dramatic results. The 30-year bond today up 0.9% as compared to just a third of a percent for the 10-year, and basically a flat result, less than 0.1% rise for the 2-year. If we look at what the 30-year yield did, just in the context of what's going on here, it's down 1.4%. So clearly, bonds higher, yields lower, kind of a day. We can see gold post an impressive surge, up 1.8%. That takes gold to intraday, at least, the highest level since essentially a week ago, but brings it back to those swing highs, which at the time were the highest since late May. So back to monthly highs set, or 1 month highs, as it were, set last week. And I suppose monthly highs for that matter as well. And the U.S. dollar broadly lower against its major counterparts, down 0.83% against the euro and 0.64% against the yen. That generally echoes what's going on across the dollar universe. The overall dollar index that takes the value of the greenback against its major counterparts overwhelmingly down, and that's close to 0.6%. So we have a clear kind of story of lower yields, lower dollar, higher gold here, and that, of course, paints a picture of more easy monetary policy as a suspicion for the catalyst. And indeed, there are reasons to consider that as precisely what has occurred. Here's the data driver when all of this starts to take shape, and sort of what Equities did is a bit interesting because this is, of course, where they find their gains, having been soggy overnight, and then they kind of run out of steam into the end of the session, in particular in the NASDAQ, which is an interesting caveat to this story. But there is the data right here, and this is the producer price index. And we'll take a moment here to dig into this because it is actually very important to the overall narrative. So we saw in April this shock decline in the producer price index. And this, of course, was comparable really only to what we saw right around the onset of COVID. And what this spoke to was the idea that there was inflation that came vis-a-vis the tariffs, but then that inflation didn't really show up in consumer prices because, as we've looked at before, this is April's data, and here was that decline. It was mainly driven by this decline in what's called services PPI, and that's really measuring the margins that wholesalers and retailers are looking at. And we saw those margins significantly decline even as the change in input inflation for core goods rose to the highest in at least 2 years or so. And that's if you include this errant spike, this 1 month, this 1 month jump. And if you don't, and you sort of look at this as an anomaly and look at this back over here, this was the biggest jump since the inflationary swell in the wake of COVID. So this was indicative of businesses eating a rise in input costs without passing it on to consumers, essentially taking the hit in margins, lowering their margins by 1.6%, as a matter of fact, which was a significant amount for just a single month, and in a sense insulating consumers from the cost hit from tariffs. Now, what we see in this data is that they've started to rebuild those margins back. So not only do we get a month-on-month rise in PPI after this sell-off, we can see that though you have that, the overall core wholesale inflation rate actually declined to 3%, and that was the lowest since August of last year. So you get wholesale inflation coming down. Meanwhile, we can see those trade services margins get rebuilt, both for finished goods, is what you can see here, a significant rise in margins across the various categories of trade services, with the biggest increases clearly seen here in machinery, equipment, and parts. But the upshot here is zero. All these numbers are above zero. That is to say, those margins are getting rebuilt. We likewise see in intermediate services, here was this dramatic decline in margins. Of course, now we've seen those jump back. And again, this was the steepest since some years ago, but clearly we've rebuilt. And that we still have core inflation going this way at the wholesale level, even as margins rebuild, that was encouraging if you were concerned that there was a consumer price index mirage here, telling you that you don't have tariff-driven goods inflation to spook consumers and hurt the economy, but that only looks that way because at least in April, those consumers were shielded from those price rises. They stopped at the wholesale level and didn't make it all the way to consumers. Now, yesterday, of course, we saw consumer price index data that came in a little bit softer than expected, but generally in line with recent dynamics, this kind of encouragingly normal set of numbers, where the core stayed at 2.8%, the headline increased less than expected from 2.3 to 2.4, whereas a rise to 2.5 was expected. But most importantly, goods inflation, excluding food and energy, this bit where you might have been worried that there's going to be a tariff pass through of costs, that didn't happen again. But markets didn't really run on this because they seemingly looked at it and said, right, let's look at the PPI before we make up our mind here, because if this is anything like April, it might be a mirage again. Well, apparently not. Because as we look at this this set of PPI numbers, it is lower, and it is lower despite the fact that the pass-through has seemingly resumed and margins are being rebuilt. In other words, we have a genuine sense that maybe inflation isn't as hot as people feared, at least for now. Moreover, we also have jobless claims surging, pointing to a weakening labor market. The 4-week average for initial jobless claims up here to some of the highest levels we've seen in quite some time. We can see the reference point here is 2023. So we're talking about nearly a 2-year high on the 4-month average for initial jobless claims. So we have cooler inflation and a labor market that seems to be continuing to weaken. See jobless claims here, again, the 4-week average building into a steep advance really since the beginning of the year. And now overcoming anything we saw last year and going back to this scare here. So all of this, not surprisingly, giving you the sense that the Fed may have room to cut rates more vigorously than was feared, at least at the start of the week. We can see here we've almost fully realigned with the baseline expectations from the Federal Reserve. It said in December and then reiterated in March that it is looking to see 100 basis points in rate cuts over the next year and through the end of next year. So that's 100 basis points in 2025 and 2026 taken together with 50 basis points apiece. We can see here we've realigned within a hair of that here. The total tally now baked into Fed funds futures, 97 basis points. Next year is fully aligned with the Fed at 50 basis points. This year, almost there at 47 basis points. And perhaps most importantly, we can see that this cumulative line was meaningfully less dovish earlier in the week. It has now moved back. So we've on net moved by almost 10 basis points in a more dovish direction since the start of the week, and the mix here has reshuffled. So while, for example, as yesterday, we were looking at a similar tally, 97 basis points on net, it was 44 basis points for this year, 54 for next. So there was a bias here, and at the start of the week, it was even more dramatic, 40 basis points this year, 50 basis points next year, for a total tally of only 90, suggesting that there is less scope for rate cuts and that this year would see meaningfully less, while next year would see comparatively more, because the Fed is biased to waiting later and doing more next year versus being more cautious this year. You can see that has somewhat unclenched here. And so, not surprisingly, against that backdrop, we had this response from markets: lower yields, higher gold, weaker dollar. Now we turn to the last bit of U.S. economic data for the week, the University of Michigan Consumer Confidence Survey. And this is perhaps the most potent leading indicator for what is actually the most important contributor to economic growth: household consumption. And what we are looking for here is a slight improvement. We hit this near 3-year low in March as inflation expectations surged. We anchored a little bit in April, where the expectations index, you can see, nudged up a little bit, even as the current conditions index continued to deteriorate. And this seems to largely reflect the pause in the White House's reciprocal tariffs above 10% at the start of the month. So we had that big shock with Liberation Day and the foam board, with all kinds of large tariff rates across many countries, and not surprisingly, the markets freaked out. We then had, marking the bottom for stocks in April, the announcement that those rates would be put on a 90-day hiatus. And then a little bit later, so initially China was excluded. Then we had some conversation making by officials in Geneva, and reiterated by another meeting in London just this week, after there was a little bit of a tussle back and forth, sort of putting the Geneva deal in question. Well, it seems like we've walked away from that. And so we have a situation in April where there's slight anchoring in the expectations component of consumer confidence around the idea that we have this 90-day hiatus, and maybe we don't have to quite go as far as the foam board told us. So what we look at now then is a little bit of an improvement in consumer confidence. And of course, this is very much a critical input, because as we saw in the first quarter GDP numbers, the mess around front running of tariffs creates all kind of fuzz in the GDP data. We saw this dramatic jump in imports, a huge burst of inventory building that ends up in the investment component. And what that gives us is a narrowly negative GDP number, because this enormous import jump around front running of the tariffs skews the data. And everybody, of course, looked and said, well, that's not a real negative number on GDP. It's just the front running of the tariffs. That's going to run its course eventually. And arguably now, as we head into the end of the second quarter, that has already run out of steam. In fact, looking at data out of China, as we did yesterday, we saw that on display. But the real takeaway here wasn't really the front running of the tariffs. Because if we look at the components of GDP, we can see the external sector is an afterthought when we compare it with what is the main driver, the real driver of U.S. economic growth, which is, of course, household consumption, domestic consumption. And that's 68.5% of GDP. Whereas if we net out exports and imports, which is what we do when we do the GDP calculus, exports add to GDP, imports subtract from GDP in the math. And so what you do is you take net of the two, and we can see here exports are over here, imports are over here. Imports are slightly in excess of exports here, so we have this net deficit. And what we find is that this on net is less than 4.5%, 5% of the overall GDP pie. So you would need these dramatic swings to really see this make a meaningful impact. But consumption, the most significant part of the story, that's at the weakest in almost 2 years. Going back to a reference point in the second quarter of 2023. Moreover, just today, we got a release from the Fed that's tracking the financial accounts for the United States, and that showed that household net worth fell nearly 1% year on year in the first quarter. And that's the first decline since we had one in the third quarter of 2023, and the largest since the third quarter of 2022. So the consumers clearly retrenched here in the first quarter and decided not to come out and spend. And this is why this consumer confidence reading is so important. If we continue to see relatively weak consumer confidence, well, that might boost the case for the Fed to move sooner, as the CPI and PPI numbers might suggest. If, on the other hand, consumer confidence goes higher, then maybe that case is diminished. The worst possible thing here, of course, is if we continue to see very elevated one-year inflation expectations from consumers, because that would, of course, get the Fed thinking twice about rate cuts, because it doesn't want to let those inflation expectations run and get unanchored here, because that would show up in overall inflation data rather quickly and hurt growth. So how these numbers are going to shape expectations for what the Fed does next ought to be very interesting. If inflation expectations come in a bit and consumer confidence stays relatively tame, in particular around things like this surge in jobless claims pointing to a weakening labor market, well, then you might get a replay of what we saw today. That is, more Fed rate cuts being baked in. But the question then is, can equities make hay of it? They were the most soggy of the responding asset classes here, perhaps because the case for Fed rate cuts is also the case for a weakening economy. That's not the best news for cyclical assets that look to U.S. economic strength to fuel earnings growth. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm back with Chris on Fridays for Futures Power Hour, as well as Mondays. On with Victor Jones for the Price of Truth on Tuesdays. Back with Victor and Tom for First Call on Sundays. Writing for the News and Insights portion of tastylive.com. And commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Thanks very much for watching. Macro Money is back next week. Happy trading.